Good day, and welcome to the third lecture series being brought to you today. My name is Doyle Roberts, and I am the presenter for today's topic on angel investing. Many persons out there in the world of business looking for finance have found themselves after the bootstrapping phase and friends and family rounds. They find themselves in a position whereby they need a larger investment of capital, whether it's as small as $10,000 or onwards, upwards to say $1 million. And what the normal pathway is once you've started your company and your business is doing well, you get to a place where your company's valuation is reasonable and your market scope and sphere is very lucrative. You may need angel investors to help take you to the next stage of capital. In terms of what is angel investing, what we find is that angel investing involves the provision of capital by an investor to an early stage company in exchange for some ownership or view towards future ownership within the company structure. For entrepreneurs who determine that bootstrapping, that is launching a business without outside money, is suboptimal, angels occupy the early financing space between the three F's, as I made reference to earlier: the friends, family, and fools, as some would say. In terms of what angels are, what we find is angel investors are accredited investors, and in terms of the angel round, an angel round, this is a round of outside investment into a company. This varies widely and can range from between, like I said earlier, as little as 10,000 onwards up to $1 million, and in some instances, $2 million. Angel investors themselves, they're wealthy individuals who personally finance the same high-risk, high-growth startups as venture capitalists would, but they tend to come in at an earlier stage. In terms of accredited investors, angel investors are generally accredited investors. Under Rule 501 of Regulation D of the Securities Act of 1933, meaning that, in short, they are high net worth individuals. These are individuals who earn anywhere between 200 to 200,000 and above in yearly salaries, and have assets ranging at $300,000 and above. Angel investors generally invest their own capital and not the capital of third parties in early stage companies. Angel investors invest at a very early stage in the company's existence, even earlier than when most venture capital funds might invest. Basically, what this means is that angel invest in companies when uncertainty and risks are very or especially high. In terms of the deal size, the average angel deal size, or the amount invested in a single round in the first and second quarters of 2011, it was just over $338,000. According to the Angel Capital Association, the median investment per round per angel group in 2008 was about $277,000, and many angel groups co-invest with other angel groups and individual angels to make investments of, say, $500,000 to $2 million per round. In terms of how big the angel investing sphere is as an asset class, it has been roughly estimated that $25 billion in new ventures funded each year. Not to say that is the highest trend. There have been trends as high as $60 billion at the height of the dot-com era in, say, in the year 2000, for instance. So what we're looking at in terms of when you as a business person is looking to take your business to the next stage is you're looking at a very huge block of money that you can access, and it comes with a lot of different benefits that you would not find if you were dealing with venture capitalists per se, or other private equity firms. Let us break who angel investors are. Who are these angels that you would be approaching in your angel round? What we find is that angel investors are usually entrepreneurs or retired business persons who've exited their businesses in most instances. These are persons who have that entrepreneurial spirit, and they view angel investing as a means of, say, giving back to the society and their individual communities, as a means of showing appreciation to those who mentored them in their early years or their early days of doing business. What we find is angel investors invest both their time in terms of their business acumen and in terms of their business knowledge base. They invest their money, which is the most important thing. There are a lot of different motivations for angels to invest, but what we find is that most angels have many interests and view angel investing as really a part-time activity, unlike venture capitalists. Angels who enjoy mentoring and coaching entrepreneurs, and especially assisting in the growth and success of their portfolio companies, they come in many different forms. But before we get into that, we need to differentiate the difference between angels and venture capitalists or VCs. What we find is that angels use their own money first and foremost, and venture capitalists, they invest other people's money in early stage growth companies. Venture capitalists, they tend to raise substantial amounts of money from pension plans, university and foundation endowments, wealthy individuals, corporations, and they invest those monies in growth projects, growth ventures per se. The funds themselves, the venture capital funds themselves, are usually managed by venture capital as general partners, while the limited partners are passive investors. Venture capital funds range in size from a few million to hundreds of millions of dollars in terms of their investing capacity. A single venture fund is usually designed to have a life of 10 years with the possibility of extending that particular fund's life for a few years thereafter. Fund monies are invested in the first 3 years, and investments are harvested 3 to 10 years later. So in terms of raising several funds over time, you may have 2 to 4 active funds under management by a VC firm at any given point in time, but usually at different stages. In terms of understanding who the general partners of the venture capital firms are, they, in terms of their capacity, they usually do not have any of their own personal monies or funds in projects. They usually, if they do, they usually invest about 1% of the capital that is underneath their funds management, with the rest coming from other limited partners. They tend to pool their resources. The general partners charge the funds raised an annual administrative fee of anywhere between 2 and 3% to operate the fund, the facilities in terms of salaries, etc., and plus a 20% carried interest for those of you who are looking at starting a fund. The carried interest is the venture capital's share of the earnings of the fund after the capital is returned to the limited partners. With only 1% of the monies invested, you can see that venture capitalists have a huge upside potential for successful funds in terms of splitting the earnings of the fund 20 to 80 with the limited partner investors after the capital is returned to those investors. Now, in terms of exactly how VCs and angels differ, the first point that I alluded to earlier was that they invest their own money, while VCs invest the monies of their limited partners. Also, VCs are full-time investors, and VCs tend to have a fully staffed office, while angels tend to work alone or with other angels. And it is, in terms of the administrative support, it is rather modest. Angel investors tend to invest in seed and startup, or what they call pre-revenue ventures, and early stage companies, while venture capital firms tend to invest in later stage growth companies. VCs generally pick a few business segments in which the general partners have substantial experience and make all the investments in these particular fields. For instance, you'll find that some VCs firms only invest in in the technology sector, and they won't really bother with other sectors. And this is something that you're going to encounter as a common feature amongst those within that particular sector of funding. In terms of what motivates most angels, what you'll find is they tend to be motivated by the giving back, as I said earlier. They also have they're more interested in the active investing instead of the passive investing. When I talk about active investing versus passive investing, active investing is when the investor is engaged in the operations of the investment. For instance, in terms of looking at, say, a restaurant investor can either be passive or active. In terms of, say, if he wanted to be a passive investor, you just give his money and sit back and let the managers do their jobs. Active investors, they tend to want to be on a day-to-day basis in the restaurant, and so on and so forth. In terms of if you were to look at other forms of investing in terms of passive and active, in terms of if a portfolio of companies on the New York Stock Exchange, for instance, was invested in, most portfolio companies tend to be passive investors in terms of their daily activity. What we find is day traders, on the other hand, are very active investors, always looking for any skews or fluctuations within the market itself. Most limited partners within venture capital funds are normally passive investors, while general partners are active investors. In terms of the different styles of investing in private companies such as your own, what you'll find is most VCs invest through funds, limited partnerships, or private placement memorandum, and are not engaged in active management of these companies. I'll say this again because that was a very important point in terms of how a lot of the investors would invest. Many invest through funds, 1, 2, through limited partnerships, or 3, through private placement memorandum. I want you to really stick a pin in the private placement memoranda section, because that is going to be one of the more active means and the methods that you're going to be raising funds for your business. When we look at the differences in terms of the active, angel investors tend to be more coaches and mentors, and they want to serve on your board and so on and so forth. That isn't the case with venture capitalists. When we see investments among angel investors, you'll find that several angels will usually invest in a startup company. They're not really interested in going it alone, but you'll be able to find that if you seek the single investor out, his network of associates and business partners and whatnot will open up doors to other angel investors that will invest in you. When angel investors come on board with your company, what you're going to find is they're going to be in a position where they're going to want to focus on certain areas to assist you and help develop your business model. The first area you'll find that they may want to become actively engaged in your companies. They'd want to serve on the board of directors, perhaps even as chairman. The second area, they'd want to mentor the CEO on operational activities. The third is they'd want to be actively engaged in the process of interviewing candidates for key management positions. They also tend to want to assist management teams in the design and operation of sales channels. In terms of, they tend to work with your controller in developing useful financial metrics for measuring the parameters of your company. They also assist in crisis management. They work with the CEO and the management team to help iron out the rough patches, so to speak. They're also serving as beta testers for new products that you as an entrepreneur may want to launch out there. In terms of, they also assist management in selecting and using key tools. When I say key tools, such as your software accounting tools, for instance, based on their historical experience in being in business themselves. What I want to talk to you about now is why angel investors only want to invest in companies that will scale. What exactly does this mean when I say invest in companies that will scale? Well, what it means is they only want to fund companies. It means funding companies that will grow very rapidly within the first 5 to 7 years. This would provide an opportunity for the investors to basically exit with a high multiple return on their investment. And this is one of the fundamental reasons why angel investors want to invest in those type of scenarios. To give you a working example, a pre-revenue company, for instance, valued at say $1 million at the time of the investment, it grows to a high profitable company with say $25 million in revenue. That could be valued at say $30 million in 5 years, and this is a highly scalable investment model here. And what this particular model will result is a 30 times the return on investment, or ROI, which is 100% a year for the investors for this company. So, this in itself would be seen as a very good scenario for angels to come into. And what you'll find is that they can make 25% in terms of the ROI, the return on the investment. They tend to see those as successful investments. So that is one of the parameters that you as a business person will want to ensure is in place within your company to make your company welcome to angel investors. The thing about it is angel investors, they take a lot of risks. So what you would find is they would not put all of their monies into one hat, so to speak. In terms of the average angel investor, say they want to invest $1 million of their monies, what they would normally do is they would break that down into 10 portions and would invest in 10 different companies, say $100,000 each company. And this ensures that their portfolio is somewhat balanced, and in terms of the chances and the probability of success, it ensures that they will garner some degree of greater success. Another topic or another issue that you're going to encounter which you may encounter is the term mad money. Basically, what mad money is this is the cash that angels will not need for retirement, and this which may be spent, somewhat, in the casinos. This mad money is that type of money that they tend to put out there for investment. In terms of the average portfolio strategy of the angel investors, like I said earlier, they're high. They tend to go into very high risky situations that venture capitalists would not enter into. And what you find is angel investors, they tend to invest a small fraction of their net worth in angel deals. Also, startup companies often require multiple rounds of investment to achieve success if they're going to be dealing with angel investors. So you'll find yourself in a scenario whereby, say, you needed to raise $2.5 million for your venture. What you may have to end up doing is maybe doing 2 rounds, 1 round, 1 round for $1 million apiece, and the last, say, a bridge financing scenario for $500,000 to give you the requisite amount that will take place. In terms of the active angels out there, what we find is to every one venture capital firm, it is believed to be a ratio of 10 to 1, in favor of more angel investors being out there. In terms of the typical investments that they tend to go into, companies that they're familiar with, and in terms of what they're looking for, in terms of what their seed funding or startup funding is, they're looking to purchase ownership in your company in terms of equity, in terms of an equity position, and it is not a loan or a debt that the company incurs. So this is what makes it a good means of raising monies. But personally, myself as an advisor, I tend to steer my clients away from angel investor funding and venture capital funding until it is absolutely necessary for their business, and in terms of ensuring that if that particular funding round is not necessary for the company to be productive and profitable, I normally advise my clients to avoid that particular scenario. In terms of angel investors investing in multiple rounds with a single company, yes, that scenario has happened in many companies before. In terms of the regionality or the nationality or the locality of angels, most angel investors, they tend to prefer dealing with companies within a 100-mile radius of their home base of operations, which is usually their hometown, so to speak. You got to keep in mind that excuse me. Yeah, you must keep in mind that most angel investors are retired individuals who have done the whole traveling thing, so they're not really interested in pursuing that lifestyle further in their semi-retired state of affairs. In terms of compensation for angel investors, if they were to play a role within your company, the thing is, in those companies which angels are rather passive, it is likely that other angels who invested in the same round are active. What we find is probably because they have more appropriate skills and experiences for this company. It differs from situation to situation, scenario to scenario. Angel investors normally do not take an active management role in their invested companies. So that is something, rather they prefer to serve as mentors, coaches, and directors within your company. So you won't have that issue to contend with in the early stages of your company. Now, in terms of when you move into the next round of funding and dealing with venture capital firms, that becomes an issue that you would have to consider. Angel investors, they consider their mentoring and their coaching of entrepreneurs as a part of their investment, and they also they see it as an opportunity to keep in close contact with their investment. In terms of compensation for serving in this mentoring role, it is not something that can be financially ascertained at that point. It's normally you see the results once the investment becomes profitable. In terms of control of the company, angel investors they only seek a percentage of your company structure. They're not looking to control your company. In terms of the equity size or scope, most angel investors would invest for anywhere between 1 to 25% of your company, and in terms of scaling it down when there's time for other investors to come on board, that is something that is normally done. So in terms of who is controlling the company, it boils down to that the shareholders will control the company, and it's the shareholders who would elect the board of directors. It's the shareholders who elect the directors, as I said, and depending on what state you're operating in, a majority of the share ownership of the company can normally elect the majority of the directors, and that is where the control of any company comes into play. So in terms of structuring your company, what you'll find is that most startup companies, the founder, CEO, and the founding team have a majority of the ownership shares and hence control of the board of the company. So it won't be an issue as to you, as in this early stage, losing control of your company. So I don't think that is something that isn't something that you should really stress yourself over in terms of the angel funding round. In terms of looking at angels, what I find is angel investors tend to be less hostile or aggressive in terms of their dealing with new ventures. And what you must realize, or what you must never really forget, when you're taking money from investors, it is very similar to basically entering into a marriage, and in every marriage you want to ensure that it is evenly keeled, and you do not want to get into a business relationship with somebody who there's a personality clash, or the management styles are so different, so diverse from each other that it makes for a poor operation of your company in general. You see, in terms of looking at the role of the CEO, what you'll find is the CEO is responsible for running the company, and he serves at the pleasure of the board of directors, and they establish the policy and direction of the organization. And so in theory, the CEO does not report to the chairman, but to the board as a whole. In many companies, the CEO and the chairman positions are held by the same person, making the question of control somewhat mute in this instance. But the duties and responsibilities of the CEO and chairman vary substantially from company to company. The CEO or entrepreneur who is not the chairman, I would suggest that they work closely with the new chairman to negotiate the roles and responsibilities of each position. In terms of who should be chairman of the company, this is something that has plagued many startups, and we see it on a regular basis being played out on the public, within the publicly traded companies. In terms of early stage companies, it is often, like I said earlier, the entrepreneur who is normally the CEO and sometimes the lead of the investor group. It is best practice that the chairman be the most qualified director. This is likely a director with substantial board experience, often an investor who works well with the entrepreneur slash CEO. When by selecting an experienced director, the board is removing a substantial burden from the shoulders of the CEO. The chairman can work with the CEO and other directors to establish the agenda for meetings and make assignments for preparing reports for the board. An administrator within the company can be selected to collect and collate reports to be distributed with the agenda to directors in advance of the meetings. This chairman also moderates board meetings to allocate appropriate time to the subjects of interest to the board and assure that proper minutes are taken at the meeting and distributed later. Selecting such a chairman leaves the CEO with more time to run the company without threatening the CEO with control issues related to the meetings of the board of directors. This is just my take on this scenario. In terms of the other issue that you as an entrepreneur or financier need to be mindful of is founder vesting. You'll encounter this term now more commonly so than it occurred back in the 90s and the early 2000s. What founder vesting is used by investors to protect the interests by keeping the founder accountable in the tough times of starting and growing a company. Because what most angel investors or venture capitalists, in terms of investing with you, the entrepreneur, what they do not want to do is give you this money, and somewhere in the midst of trying to accomplish the various milestones, you decide to just simply retire. Or to give you a better working example, say for instance, angel investors, they like your business plan, they like your private placement memorandum. They decide they're going to invest $500,000 with you, $500,000 in your new company by pooling their resources together. So now, for this $500,000, you give them 30% equity of your company, and you, the entrepreneur, now own 70% of the company. So it's a 30-70 split. Now, after about, say, 4 to 6 months, you, the entrepreneur, you realize you really don't like that stress and that intense pressure of being that entrepreneur. And that, combined with getting that comfortable salary within the company confines, you start to put aside pursuing the milestones of the company. So what does this do to the investors? You have an entrepreneur that's not interested in pursuing the milestones allocated for in the company's business plan. Other than taking legal action to stop you, the entrepreneur, from using up the money to pursue your personal interest and gain, what this does is it ensures that a percentage is allocated at different milestones, that at the end, you, the owner, would say, if you started out, you would start out with 100% before you take on investors. When you take on an investor for, say, that $500,000 in exchange for 30%, your equity position in the company is then converted to, say, 25 or 30%, and only as you reach distinct milestones, you're gonna be compensated for your former shares. Like I said, the investors would use the founder vesting to protect themselves from this type of disaster, because what this does is it temporarily reduces the founder's ownership of the company, and it gives the ownership back over time. And as the company meets the agreed upon milestones, then the owner or the founder would be restored his equity position. In terms of what this does, ensures that the company is able to move forward in a comfortable way. What it also does is it ensures that the investors know that their monies will be pursued. In terms of the milestones, what you'll find is the milestones can be anything from receiving letters of intent from future customers. Another milestone can be completing a new deal. Another milestone can be completing your prototype. Another milestone can be delivery of your first order. Another milestone can be attaining the cash flow break-even point. Another milestone can be finally generating revenues in excess of $1 million annually. But what this does is in terms of the breakdown, as you get to those ownership, as you get to the ownership equity, the equity of the angel investors that gave you that $500,000 would remain at the same thing, at 30% in terms of their ownership. And you, the entrepreneur, you would start off with say 100%, then you'd go down to 20% in the initial, immediately after the investment, you'll only own 20%. Then say after 6 months after the investment and accomplishing the milestone that you've agreed upon, you'd be given a 25% position. Say after 12 months and obtaining the other milestone, your position will go from 25 to say 35%, and so on and so forth. Another 18-month milestone, a 24-month milestone, a 30-month milestone, etc., etc. And you, the entrepreneur, are seeing these particular breakdowns. In terms of looking at the companies that angel investors are attracted to, and in terms of looking at the sources of capital for startup entrepreneurs, outside of friends and family, like we included earlier, let's look at yourself first and foremost. The most important source of capital is your earnings and savings. These would include second mortgages on your home and other assets, be it stocks and bonds and things of that nature. But the more capital that you can provide, the less needs to be acquired elsewhere. Okay. In terms of the least expensive source of capital is research and development grants from government agencies. If you're just starting out and you're still going through that bootstrapping round, and I would suggest that you apply for the research and development grants from funding sources close to your home base. And keep in mind, these funds can be expended on developing your company's infrastructure in terms of your technology, and this cash does not have to be paid back. So this is a good source as well. The other source critical to you would be, like I said earlier, the bootstrapping. What we find is as much as just as recent as 2010, for instance, as much as $80 billion was invested in startup companies in the U.S. by informal sources of capital, that is friends and family. So you cannot really neglect the friends and family round, thinking that you don't have those resources in alignment with where you need to go. What we find is VCs and angels invest basically even amounts in terms of $20 billion per year for seed and startup, whereas VCs they tend to invest in later stage companies. In terms of the type of companies that angels fund, like I said earlier, the company has to be scalable. You'd find that angels would invest in companies that are retail companies, life science companies, high-tech companies, manufacturing companies, and many business segments. So you cannot exclude your company from being able to be funded comfortably through angel investment funding. Now, you must always remember that angels are only going to invest in companies that can provide a very high rate of return. And they're not going to change their portfolio of being active investors. In terms of what stage or fund, what startup stage that most angel investors look to invest in a company, they want to see some traction. I cannot stress that enough. They want to know that customers are going to purchase the products and the services that you're offering to the market. And this is simply because they want to know that they're going to make their money back. They are investors. You see, they are investors. You can't get around that. Another point that I don't want to leave too far behind in terms of your board structure and size and things of that nature. A good board size would be 5 to 7 competent individuals who are familiar with the areas of their responsibility, and who are not who are going to bring value to your company structure. There's never too early a stage to look for angel investor funding. In terms of what they're looking for is basically they're looking for a fundable company, and they're looking for a fundable CEO. In terms of dealing with investors, I would tell you that you need to be absolutely truthful in your dealings with them. I would tell you also in order to qualify, or in order to be a step above, I would tell you to ensure that your management team is top notch, top rated, and they bring a support to the team that adds value, like I said earlier. In terms of the percentage of equity that you would give to advisors and in your company, try and keep it to no more than 1% equity in your company. Also, one thing that I must draw to your attention, as entrepreneurs, they tend to see their business as a baby, and there's more emotional attachment because of the hardships that would have been encountered in dealing with developing this company. But the average founder / CEO needs to keep it in their mindset, or if only at the back of their mind, that they should be prepared to step aside after the company has achieved certain milestones. And they should be more than happy or willing to help investors hire other top grade or top notch CEOs that can help expand the business model, that can help expand the profitable bottom line. This is something that here it is. You must realize that the bottom line for investors is they want a substantial return on their investment within a reasonable time frame. And if you as the founder CEO is not equipped to do what is required to take the business model to the next stage, then you should be more than open and willing to give that on to somebody else that can handle that particular role or position. Most first-time entrepreneurs have been accused of being egotistical in this regard, in terms of releasing the baby. You see, it is somewhat similar to the model of a mother taking her child to kindergarten for the first day of preschool. It's difficult to be separated from your child in that degree, but you do not stop being a parent. You still continue to be a parent. It's just that your capacity or your role would have changed dimensions, and this is something that you should prepare yourself for. You, in terms of what, um, in terms of what investors are looking for in terms of entrepreneurs that they would like to fund. They look for individuals that are honest, truthful. They look for individuals who have a sound moral compass. Um, they look for individuals that have interpersonal relationships with a variety of different individuals. In terms, they look for individuals that will be managers with skill. Uh, they look for individuals with personality, not necessarily strong charisma, but they look for individuals who carry themselves with professionalism in terms of their presentation of themselves. They look for individuals that are coachable. Here it is, a lot of entrepreneurs in the early stages of their business. Because it's their idea, they think they know every single thing about it, and they tend to not seek the advice and the counsel of others, so to speak. They're what you call the consummate know-it-all. Other qualities that investors look for, they look for individuals that are passionate and committed to their business model, their business. In terms of the management team itself, they are looking for managers that are of an A grade, so to speak. What you find is typically A grade entrepreneurs hire A plus managers, while B grade entrepreneurs hire C grade and D managers. You as an entrepreneur, you cannot be afraid to hire persons who you may feel are smarter than you. In fact, I personally recommend it highly that you surround yourself with individuals whose intelligence and knowledge base brings so much to the table that you find yourself being elevated in your thinking and being inspired to do more. In terms of what I recommend to individuals who have not been funded as yet is work on the bottom line. The pro forma financials have not yet been validated, so start doing what you can do. I mean, inaction is not the answer. Inaction is always the key, or is always the means of dying, so to speak, in business. Another area that you may want to consider in getting funding from angel investors is the issue of non-disclosure agreements. Many entrepreneurs, they feel that their ideas are so unique and so on and so forth, but here it is. You must realize that the average angel investor or VC, venture capitalist, they receive so many business plans on a weekly or daily basis that and in a lot of instances the ideas are not really new per se. Out of the average, say, 300 to 1,000 business plans received, the average, I would say, about 10 of those would be workable models that can get sensible traction. So the idea that many entrepreneurs have that they don't want to disclose, or they don't want to show their business construct to investors without non-disclosure agreements, I have some news for you. Most investors don't sign non-disclosure agreements. That's just the nature of the business. Most don't. If you have some innovation that is secret and it is detrimental to the uniqueness and the individuality of what you're offering, then you may want to first and foremost, make sure that your scenarios are patented if it's some type of prototype, and you may want to present a non-confidential business plan to your investors. And yeah, but if your business plan is so scalable and you this secret issue is there, most most investors, they may concede to what is known as a very narrow non-disclosure agreement to enter into with you. But the essence is to write a great non-confidential business plan to begin with. Intellectual property, that is something I must tell you that seek out all the necessary patents. We will be putting out something later on in this lecture series about patenting ideas and models and constructs, and to ensure that you're fully protected. But intellectual property is something that you need to secure. I would suggest you seeking out an intellectual property specialist at this particular point. In terms of the planning, growth, and funding strategy of your company, if your company is scalable, and you see where rapid growth is something that is going to happen, and you have a large niche market, if you have a proposed sustainable model that can reasonably be expected to provide a substantial return on investment in 5 to 7 years, you can look forward to obtaining funding rather quickly. In terms of looking at what venture capitalists and angel investors approach, to understand what is happening today within the funding industry, what has emerged has called what we in the industry call a funding gap has emerged. What I'll tell you what that is. Okay, if you have the angel investors who typically invest anywhere between that $10,000 to $1 million, what we have in place is most venture capitalists, they tend to invest between that $2 and $3 million round. So that gap between the $1 to $2 million round is I would say more the 1 to 3. What you'll end up, that is the reason why you'll end up having to do multiple angel rounds to make up for that gap, because the reality is there are 100,000 angel investors interested in rounds of investments less than $1 million. So this is good. In comparison to only 1,000 venture capital firms interested in investing in deals with capital requirements of $5 million and larger. So here it is. In the early stages, you may want to just focus mainly on angel investors. Now, this gap that I spoke about earlier, there are few investors interested in funding between that $1 to $5 million rounds. And this is where a lot of early stage companies enter into little problem areas in terms of getting their funding sorted out. But that is easily fixed by just simply doing multiple angel rounds. In terms of avoiding it, your company needs to go where the money is. That's how it really works. But if you need, say, $3 million to meet your objectives, how do you raise capital? This is the number one question. If there's this funding gap, well, you just have to adjust your funding needs to match the capital marketplace that you're in. If you only, like I alluded to earlier, if you only need $2.5 million in capital for your company, don't waste a lot of time pursuing that particular $2.5 million. That is too big for that stage of your company development. And the reality is there are few people or a few funding sources within that gap space. So you have to actually do multiple funding rounds. So if you're wise and if you're smart and you need that 2.5 million, what we would normally advise you to do is raise that $500,000 and then plan to raise 2 additional rounds of $1 million each as you achieve your milestones, as I told you earlier. If you need to raise 6 million to achieve your positive cash flow or more, and the milestone you're trying to achieve is say $800,000, then I would tell you to then go and seek say $5.2 million from venture capitalists who are interested in this business type of model. Entrepreneurs need to understand that the more you know about the capital markets, the easier it is for you to get your funding done successfully. And you got to design a funding strategy that matches the capital markets and the time that you're in. Within the 80s, the popular thing was the leverage buyouts. Within the 90s, the private placements came out with a new resurgence. But if your company is moving forward in terms of getting milestones, or achieving your business milestones, what you'll find is that funding comes rather easy, as I alluded to earlier. So set your milestones, clearly within your business plan, and you have to match your milestones with your funding plan to ensure that you get the maximum amount of monies that you're looking for. In terms of the compilation, in terms of the stages, after you've finished with the friends and family rounds and bootstrapping and so on and so forth, and you've moved from angel investors, the next key step is just simply going into the venture capital arena. But you must always ask yourself, as I said earlier, is it really necessary? In terms of when you should begin or seek your first angel round, I would say that once you get to the place where you need to raise anywhere between, say, $300,000 to $1 million, this is when you should start pursuing angel investors. You should put it off as long as possible, but the rule of thumb is angels prefer to invest in companies who have completed their product development and have shown that the product or the prototype of the product has been presented to potential customers, and the dog is willing to eat the food, as is common within the market economy in terms of the saying. In terms of the angel investors will invest earlier in startup companies, but they will demand a greater ownership share of your company. So this is something that you should brace yourself for. In terms of when you should seek funding, your funding plan should be tied into your milestones, or it should, or put another way, your company should have a milestone-driven funding plan. What I suggest to most clients is that because each round of investment should provide 12 to 18 months of cash flow in terms of months of operations before you run out of funding. And you know that the reality is it takes anywhere between 3 to 6 months to raise money. If you're wise in terms of your timing, you should begin raising funding for your next round 12 months within the 12-month period before running out of money. You don't ever really want to run out of money in your business operation, because it kills the attractiveness of your business to future investors, and it speaks to your management style. If you know that you only have a 12 to 18 month supply of cash flowing through your company, why would you want to wait to the very end before you decide to start raising money? Give yourself enough time to arrange the necessary channels that are going to bring you the funding that you need to get your company to a good place. What you must also be mindful of is down rounds. Or in terms of understanding what a down round in your funding is, this is a round of investment in a company in which the current valuation of the company is lower than at the time of the previous round of investment. I'll say that again. A down round is a round of investment in a company in which the current valuation of the company is lower than at the time of the previous round of investment. The result of a down round is that early investors get crammed down, so to speak. So you as an entrepreneur, you are endowed, or you are bestowed, or you're given the responsibility of ensuring that your earlier investors, they do not feel the pinch of a down valuation, because it affects their ownership or their equity position within the company, and that can be somewhat problematic for you in future rounds. So in terms of trying to avoid down rounds, while your investor rights look good on paper, they only tend to drive away subsequent investors, and then they may be interested in investing, but want to avoid addressing this particular issue of down rounds. In terms of three things you should do to avoid down rounds, the first thing is you should try to negotiate for an appropriate low valuation on your early rounds when you're starting up. It is rare that pre-revenue companies justify pre-money valuations in excess of $2.5 million. What I would also suggest is, to avoid down rounds, is try to raise enough money in your seed and your startup round to give your company enough, runway or free way to meet, important milestones. And instead of trying to justify higher valuations, the reality is some milestones will be accomplished easy, some won't, and you have to be aware that whatever the scenario is, you are positioned to ensure the best returns for your investors. In looking at matching milestones, you want your milestones to be rather reasonable. Okay, you don't want to hyperextend or give yourself too little time to accomplish things. When I say that, if you know that a particular capital funding round is going to come upon you within a 6-month frame, and in order to get the best out of your funding round, you need at least 3 months of preparation time. Give yourself that necessary preparation time so as to avoid any down rounds or funds just straight up not being generated within the company structure. Your startup valuation should always be based on your accomplishments and milestones. You try and identify the goals that will increase the value of your company in the eyes of investors, and most importantly, try and meet those goals. The next area of major concern that you as an entrepreneur raising capital for your business through your private placement memorandum or through whatever means of financing that you try to go through. When you're dealing with angel investors in particular, exit strategy is something that they pay close attention to. Um, in essence, the exit strategy is there for the angel investor to try and ensure or ascertain that there is a clear route for them exiting or getting their monies and profits out of the business. So, with that in mind, um, when we look at exit strategies, you must be realistic. The average individual says that they're gonna exit from an investment via an IPO, and the truth is there are other ways you can actually exit from a business without that type of complexity. In terms of how you want to structure your business for an exit strategy, uh, you must be mindful that lifestyle companies, which are intended to provide income for the entrepreneur and take no investment from outsiders, they won't need an exit strategy. But once you're in the realm of taking on investors, you have to have an exit strategy to ensure that the relationship is brought to a reciprocally agreed upon conclusion. Um, Family businesses do succession planning rather than exit strategies. So if you're doing a mom pop or Robertson Son type of business scenario, you won't have to worry so much about an exit strategy. But the thing is, what you might need to be aware of is why the exit strategy is so important for your investors. It goes right back to the beginning. They're not taking these high risks of giving you their monies, investing their monies with you, um, and the only way they're going to see any positive returns is if the business is profitable. Um, the intended exit strategy for angel investments is to liquidate the investment via either a sale of the company to a much larger company, through mergers and acquisitions, things of that nature. Um, in defining an exit strategy, it is important for the entrepreneur who is seeking equity investors, because those investors will expect the entrepreneur to be able to fully or clearly articulate a well-defined conclusion of how they're going to harvest the fruits of their labor, or the fruits of their investment in this particular instance. Um, once 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 you realize what your options are in terms of an exit strategy, whether it's an IPO, whether it's a merger or merger or acquisition scenario, um, you must realize that most investors are not going to come on board um, unless there is a clear way to clean or harvest their ownership position. In fact, it is the most important act, the final act of the entrepreneur and business relationship. Um, some would say that executing the exit strategy is extremely vital to the success of the investors. Um, I alluded to the IPO earlier, and here it is. You may be asking what an IPO is. Well, an IPO is just an initial public offering, where you take your private company public and allow, basically, it's a public offering of shares of your private company to the public. It's a financing event, or a funding round, as some would say. It's not an exit in its clearly defined framework. Uh, it's a funding round, a financing event, like I said. What it does is it allows your company to sell shares to the public, and you generate cash that is to be used towards growing your company, expanding your company. Yes, it's somewhat expensive and time consuming. I've seen IPOs take, in terms of structuring, some have done it within a 1 year to 2 year time frame. I normally tell individuals it'll take about a year and a half to do it properly. In terms of the IPO as a strategy, what this does is it opens up, as a financing strategy, it can and it often does define the exit strategy for most investors, and it can provide future partial liquidation by the entrepreneur. What I find is because public companies are often valued somewhat higher than their private counterparts. Selling investors shares through public markets can eventually be a very attractive exit for entrepreneurs and investors. Classic example of this, is in terms of companies going public. Recently, you have companies like Facebook, LinkedIn, Baidu in China, and so on and so forth. In terms of if you've gone through all of your financing rounds and you've maximized your business model, and you want to take your company to the next level, in terms of the last stage of its development, IPO is usually that place. In terms of the likelihood of an exit via an IPO or an acquisition event, most entrepreneurs make provision for the public offering, but while these are the two possible options, whether it's selling the company to a larger company or taking the company public, those two options, those are the main ways. But while these are the two possible options, it is much more likely that a successful startup will be sold more so than go public. It's perhaps about 1% of the exits of angel invested companies will be via a public issue of shares. I'd say less than 10% of venture capital funded companies may go public in terms of actualized development. The market has changed, and what individuals are realizing is they can get just as much, if not more, by selling the company, and it's less headache, so to speak. In terms of the expected exit for an angel-funded company, the expected exit is to sell the company to a larger public corporation in exchange for either cash or shares of publicly tradable stock of the acquiring company through a merger or acquisition. And when we get into that particular field, all cash exits are preferred because the liquidation is instantaneous with no strings attached when it comes to M&As. The only downside to a cash liquidation is that all taxes on the sale are due in the year of the sale. Selling for shares in a blue chip public company can also be attractive to investors because it allows the recipient of the shares to sell the shares and pay their taxes on a planned schedule over several years. The disadvantage of receiving public tradable shares is that public markets are volatile and the price of the acquired security may go down, resulting in a reduction in the return on investment of the exit. Selling for shares in another private company is not really an exit because the received shares are likely no more liquid than those sold. So it is, however, used to exit a troubled company. Rolling the dice that the merged entity will have a greater chance of success than the standalone startup company is what is being pursued. Entrepreneurs should always be aware that selling the startup company to a larger public company is often subject to a market standoff or lockup, which precludes owners of newly registered shares from selling for a restricted period, usually 180 days. This lockup of acquired shares is regulated by the SEC. That's the Securities and Exchange Commission. The purpose of the regulations is to avoid a flooding of the market with shares from acquired shareholders on the days immediately following closing, and the consequential reduction in share prices resulting from more sellers than buyers making the market. While the lockup is common in most tax-free exchanges of the shares of private companies for those of public companies, the lockup period can be avoided in certain states and under certain conditions. In terms of what investors expect in defining an exit, investors expect startup entrepreneurs to have anticipated that a thoughtful exit strategy is important to all owners of the company. Simply including a section in the business plan that states that you expect to exit the company in 3 to 5 years by selling the company or going public is not enough, and this is what so many persons out there are doing. If the entrepreneur honestly believes an IPO is possible for his or her startup company, it is important to demonstrate why this unlikely exit makes sense for this company. What companies in the same business vertical or using the same business model have recently gone public? Why is it as likely or even more likely that the startup company will enjoy the level of success as the comparable companies? What other companies in the same vertical were unsuccessful in their bid to go public, and why does the startup company have a greater chance of success than they did? If the entrepreneur believes an exit via the sale to a larger public company can reasonably be expected as an exit strategy, the entrepreneur needs to explain why such a company would buy the startup. What I would suggest is define the available target companies and define why each might be interested in buying the startup. Show examples of other strategic acquisitions made by the target companies and compare and contrast the potential of the startup to those comparable acquisitions. You must convince the investors that you understand the dynamics of your business vertical, and a home run exit via strategic acquisitions is really possible for your company. Now, in terms of what you should be mindful of is there are 3 types of acquiring companies for startup ventures. The first is strategic acquirer, would consider buying startup companies whose products and customers will allow the acquiring company to grow and succeed faster than the in-house team can grow their business without the acquired venture. Strategic buyers often pay top dollar for acquisitions, especially if they fear one of their competitors is likely to buy the startup venture. The second variety of acquirer is a financial buyer. They're looking for a successful company to purchase, planning to use their cash resources and portfolio companies to grow the acquired company very rapidly. The objective is either to operate the company profitably, spinning off cash to the buyers, or possibly selling the company after several years to an even larger company. Financial buyers tend to buy companies based solely on the numbers and pay lower amounts than might strategic buyers. The third acquirer type is the roll-up specialist. Their objective is to acquire several companies in a related industry to build a much larger, highly successful venture from a set of smaller companies. A few have been highly successful, but most are not. The currency these roll-up acquirers use is often the stock of the roll-up company, and they tend to be stingy with valuation, expecting the investors in the startup company to make most of their return upon the eventual exit of the roll-up company. This exit type is not appealing to investors, by the way. So how do you define a merger and acquisition target for exit that will make your investors happy? Who would be these strategic buyers? First off, they would be persons who understood your product, technology, or market. They are suppliers, competitors, customers, and co-vendors. Co-vendors supply your customers with products that are complementary to yours. As an example, a customer buys 2 different non-competitive raw materials, one from you and the other from a co-vendor. To best define all the targets for your eventual exit strategy, it is important to develop a complete and thorough understanding of your marketplace, including the competitive landscape for your suppliers, your customers, and sometimes your customers' customers. Finally, spend enough time in the appropriate research and development institutions in your vertical to understand the future threats and opportunities in your business segment. Will changes in your customer's environment make your products even more attractive in the future? Or might technology among your suppliers and their competitors make your product less attractive? What should you consider in identifying customers or companies, that might acquire your startup company? You can eliminate those companies that are small, first and foremost, or struggling startup companies who could never afford to acquire your successful venture. You may wish to give a low priority to larger private companies but keep these companies on the list because they may be acquired by attractive companies in the future. You might find some companies whose cultures do not match that of your company. Give these companies a lower priority, but leave them on the list because the situation may change in the next decade. Give a high priority to those public companies in your environment that could best benefit from acquiring your new venture in 5 years or so. Try to create a list of multiple candidates to acquire you. Why? Well, all investors know that you will get a better price for selling your company when several large companies compete in an auction for the right to buy your company. Who can help you define your exit strategy? Use the angel investors, use those legal advisors, use the accountants, and all of these individuals to help streamline your exit strategy. But if you have difficulties, I would suggest finding professionals like those at Wilson and Roberts who can help you do these things. If you're looking for angel investor networks, I would suggest you look at the National Venture Capital Association. That would be nvca.com. You can also look at the European Venture Capital Association and so on and so forth. But the issue now is in dealing with angel investors. In conclusion, I would say this: present a clear business vision to your investors, present them with a strong board, present them with a strong business plan with strong financial forecasts, and the more traction your business already has, the greater the opportunity for funding. In terms of the time frame, you're looking at approximately 3 to 6 months to arrange funding with angel investors. So if you haven't allotted this amount of time, you need to do so. And if you need it done within that time frame, I would suggest you hire professionals that can do the work quickly for you. This has been a quick overview of the angel investor field. So feel free to start networking and seek out angel investors out there. They're out there waiting on you. If you have any other concerns or questions, you can forward all of your questions or inquiries to wilsonandroberts.com at their email address. That's info@wilsonandroberts.com. This is Doyle Roberts, founder and managing partner in wilsonandroberts.com, wishing you the best success in your future business. Take care. Have a great one.